Have you ever watched a market and finally decided to jump in because the direction just seemed undeniable?
Only to watch it instantly reverse.
Yes, and it just absolutely crushes your position.
It is, well, it's a universal experience.
Yeah.
It's the absolute most frustrating rite of passage for literally anyone who engages with financial markets.
You just sit there staring at the screen. You know, you've been patient.
Right?
You've been disciplined. You watch the price climb and climb. Every symbol candle is green. Every indicator is just screaming upward momentum.
And you tell yourself the golden rule.
Exactly. The trend is your friend. That is the golden rule, right?
No.
Almost everyone who has ever looked at a chart is trained to follow that exact same advice.
Oh, absolutely. We are taught to find the direction, grab on with both hands, and just hold on for dear life.
Because it feels safe. It offers this beautiful, comforting clarity. You buy the breakout, you feel a genius for about 3 minutes, and then...
The giant red candle wipes out a week of gains.
And you sit there wondering if the market is like personally watching your brokerage account.
It's a terrible feeling. But the thing is, trend logic gives you a sense of control in an environment that is fundamentally chaotic.
Yeah.
When you can point to a chart and say, look, the line is going up from the bottom left to the top right, it feels like you've solved the puzzle. It feels like real understanding.
But what if that direction is just a surface-level illusion?
Hmm.
What if knowing where the price is going right now tells you absolutely nothing about why it's moving?
Or, more importantly, how long it can actually last.
Right. And that is the million-dollar question.
It really is. The reality of market microstructure is that a trend can look incredibly strong on a screen, while the underlying conditions supporting it are, well, they're already rotting away from the inside.
Wow.
Conversely, a trend can look completely broken, like an absolute disaster, while the broader fundamental move is still perfectly intact and about to explode higher.
And that brings us to the mission of today's deep dive. We are going to deconstruct what we are calling trend logic. We are going to expose its fatal flaws.
Which are numerous.
Very numerous. And then we're going to introduce a completely different paradigm, a completely different way of looking at the exact same information called campaign logic.
I love that term.
We'll explore why treating the market as a simple directional line just gets you chopped up time and time again, and how viewing it as an unfolding, dynamic process changes literally everything about how you manage risk.
And how you spot real opportunities. Because that feeling of buying the breakout, only to have it collapse on your head, it isn't just bad luck.
It's not the market out to get you.
No, not at all. That is the mathematical outcome of relying solely on trend logic. The difference between these two logics, trend versus campaign, it isn't just semantics.
It's the fundamental difference between blindly following the herd to the slaughterhouse and actually understanding the engine that is driving the market in the first place. Okay, let's unpack this. Before we can build this new framework of campaign logic, we really have to understand the default. We have to understand why trend logic feels so incredibly comfortable to the human brain.
It really does.
Why do we gravitate toward it so naturally? Are we just lazy?
Well, no, we are pattern recognition machines by evolutionary design. We evolved to find simple, linear explanations for complex phenomena.
Because it saves cognitive energy.
Precisely. If you are walking through the savannah and you see the grass moving in a straight line, your brain immediately assumes a predator is creating that trend.
You don't stop to analyze the wind patterns.
Right. You don't analyze the microbiology of the soil, you react to the obvious direction. And trend logic in financial markets operates on that exact same primal circuitry.
It is based on a beautifully simple premise. Price moves in identifiable directions, and those directions tend to persist.
The math is easy. If the market is making higher highs and higher lows, it is bullish. If it is making lower highs and lower lows, it is bearish.
It is literally the first thing you learn. You pull up your first chart, and what do? You draw a line connecting the bottoms, and you draw a line connecting the tops.
You throw on a 50-day moving average.
Maybe a 200-day moving average. You look for breakout patterns. It gives you a clear bias.
It gives you a rule book. If the price is above the line, I am a buyer. If the price is below the line, I am a seller.
I was thinking about how to describe this feeling, and I came up with an analogy. Relying only on trend logic feels like driving a car while staring exclusively at a compass.
Oh, that's good.
Yes.
A compass gives you an absolute bearing without providing a single piece of context about the actual terrain.
Exactly. You are staring at the compass, and it says you are heading north, which is great. You know your direction.
Sure.
But because you are only looking at the compass, you have absolutely no idea if you are about to run out of gas or if there is a massive traffic jam 2 miles ahead.
Or if you're about to drive straight off a cliff.
You just know, hey, we're going north.
What's fascinating here is how perfectly that captures the blind spots of trend logic. A compass tells you direction, but it completely ignores the process of the journey.
Right.
Trend logic does exactly the same thing. It tells you the direction of the price, but it completely fails to explain why the trend exists in the first place.
It doesn't account for changes in macroeconomic conditions.
Nope. It doesn't account for shifts in global capital flows.
And most dangerously, it treats all stages of the move as if they are exactly the same.
This is a huge point. Think about a chart, a trend that is in its very first week of early development.
Where smart capital is just starting to quietly accumulate.
Right. That early trend can look mathematically identical on a standard price chart to a trend that has been running for 2 years.
A trend that is incredibly crowded.
Yes, on the front page of every newspaper and nearing total exhaustion.
To the compass, north is north. A higher high is just a higher high.
The math doesn't care if that higher high was driven by trillions of dollars of fresh institutional liquidity, or if it was driven by the last few retail participants scraping together their savings.
Buying at the absolute top because of FOMO.
Exactly. Trend logic does not distinguish between different stages of a move.
But the real story is what actually happens to the people who rely on this default framework. Because if trend logic ignores the why, and if it ignores the stage of the journey, what is the actual consequence?
What happens to the traders sitting at their desk trusting the math?
Yeah.
They fall into the trap of the obvious move. Trend logic essentially forces you to enter the market at the exact moment when the move is most visible to the entire world.
Because that is when the structure is the cleanest.
Right. That is when the moving averages are perfectly fanned out, the trend lines are unbroken.
And the breakout is confirmed on high volume.
But here's the catch. When a direction is universally obvious, when the trend is clear to everyone from the seasoned hedge fund manager to your neighbor who just downloaded a brokerage app,
the best part of the opportunity is usually already over.
By the time the trend is perfectly clear, it is incredibly crowded.
I want to push back on that for a second, though.
Yeah.
Let's play devil's advocate.
Sure, go for it.
All the greatest market wizards, the billionaires who built fortunes over the last century, they constantly preach, cut your losers, ride your winners.
They do.
They are fundamentally trend followers. So if the market is making a beautiful, clean structure and the momentum is visibly consistent day after day, shouldn't we just trust the math?
It's tempting.
Isn't looking for hidden flaws, worrying about how crowded it is, or trying to guess the macroeconomic drivers just overthinking it? If the trend is my friend, shouldn't I just ride it until it breaks?
Well, this raises an important question. What does a break actually look like mechanically?
Okay.
The assumption you are making, which is the assumption built deeply into trend logic, is that markets are linear. It assumes that a trend will persist in a straight, continuous line until it abruptly and cleanly reverses, giving you a very polite mathematical signal to exit.
Like a light switch. On and then off, up and then down. You wait for the line to break, you sell your position, you book your profit.
But markets do not operate like light switches. They degrade.
They degrade.
Yes. A trend doesn't usually just snap overnight in a vacuum. It weakens gradually beneath the surface, long before the actual price reversal happens on your screen.
Oh, it's like a rotting piece of wood. It might look perfectly fine from the outside. The shape is the same. The structure looks intact.
But the termites have hollowed out the inside.
Right. If you step on it, it's going to collapse. But the moment before you step on it, it looks identical to a solid piece of oak.
That is a perfect analogy. The degradation happens in the underlying capital flows, in the participation metrics, in the narrative conviction. Let's look at a historical example to ground this.
Let's do it.
Think about the housing market and the financial sector leading up to the 2008 crash. If you were strictly looking at a chart of bank stocks or housing indices in mid-2007, the trend was still pointing north.
The structure looked generally intact.
Yes, trend logic was telling people to buy the dip. But internally, the termite damage was catastrophic.
The underlying mortgage-backed securities were already defaulting.
The credit markets were seizing up behind the scenes. The institutional capital flows were rapidly exiting, shifting risk onto the latecomers.
And trend logic has absolutely zero framework to measure this internal degradation.
None. It only looks at the exterior shape of the wood. So you end up acting on failed signals. You buy the dip because the trend line held, not realizing the structural integrity of the move evaporated 3 weeks ago.
And what happens when that clean structure starts to get messy? Because markets aren't always going straight up or straight down. Sometimes they just violently thrash sideways.
Oh, the choppiness problem. It destroys
It
accounts.
really does.
When a market gets choppy, when it starts violating minor trend lines, making marginal new highs, and then immediately reversing to make marginal new lows.
Trend logic views this as temporary noise.
Exactly. The trader thinks, oh, the trend is just taking a breath. I need to hold through the noise.
So they adjust the trend line, they zoom out a little bit to make the chart fit their bias.
They draw a slightly wider channel to excuse the messy price action.
They rationalize it because their framework demands a direction.
But choppiness isn't noise. In many cases, it is a massive, flashing neon warning sign that the underlying conditions of the market are shifting.
The tectonic plates of capital are grinding against each other.
Institutions are distributing their massive positions to retail buyers. But trend logic demands you keep trying to trade the direction.
Which leads to massive false signals, emotional burnout, and really heavy loss.
Huge losses.
So we have this compass that is marching us straight into a swamp. And we keep trusting it because it says we are still going north. We clearly need a better tool.
We need a paradigm shift.
And this is where we introduce the solution. Campaign logic. This is about looking at the market not as a line, but as a dynamic, three-dimensional process.
It is a complete mental reset. Campaign logic abandons the idea that the market is just a line moving up or down.
Instead, it defines the market as a progression that is shaped by three specific, unseen forces.
Capital, narrative, and time.
Capital, narrative, and time. Okay, let's break this down. The word narrative gets thrown around a lot.
It does.
To a skeptic, a narrative just sounds like an excuse made up by a financial journalist after the price has already moved just to explain what happened.
Yeah, a post-rationalization.
Right. So how do we define narrative in this context so it's actually a useful, predictive tool?
A true narrative in campaign logic isn't a post-market news headline. It is a fundamental macroeconomic or geopolitical driver that has the power to physically move billions or trillions of dollars.
Like what?
We're talking about major central bank policy changes, like a structural shift from printing money to aggressively raising interest rates.
Or massive global liquidity conditions.
Yes. Or structural energy dynamics, like a multi-year supply shortage in oil. Or major geopolitical developments reshaping global supply chains.
These aren't things that happen in a single day. A central bank doesn't just change the entire global economy on a Tuesday at 2 p.m., and by Wednesday it's fully priced in.
Exactly. Because these narratives are so massive, the capital, meaning the institutional money, the sovereign wealth funds, the major asset managers, they cannot simply react in a single price spike.
They are moving the equivalent of container ships, not speedboats.
That's a great way to put it.
Let's talk about the actual mechanics of that. Why can't a massive sovereign wealth fund just buy everything they want at 9:30 a.m. on Monday? Why does it take months?
It comes down to market microstructure, specifically liquidity and slippage.
Okay, walk us through it.
Imagine you manage a $50 billion pension fund. You've just analyzed the demographic shifts and concluded that copper is going into a structural, decade-long deficit.
Okay, so that is your narrative.
Right. You decide you need to allocate $2 billion into copper futures to capture this move. If you simply click buy for $2 billion worth of contracts all at once,
there won't be enough sellers at the current price to fill your order.
Exactly. You will consume all the available liquidity instantly, and your massive order will physically drive the price of copper up 30 or 40% in a matter of seconds.
You would ruin your own entry price.
You'd be buying your last batch of contracts at a massive premium. You would suffer catastrophic slippage.
So what do they do instead?
To avoid this, institutions use algorithms, like VWAP volume-weighted average price. They use these to slice that $2 billion order into tens of thousands of tiny, invisible pieces.
Wow.
They buy a little bit every hour, every day, over weeks or even months. They hide their footprint within the normal daily volume of the market.
So they have to accumulate their positions slowly.
Yes. This takes time. This unfolding process of massive capital responding to a massive narrative over a long period of time, that is the very definition of a campaign.
Let's zoom out for a second. If we put these two mentalities side by side, the contrast is stark. Trend logic looks at the screen and asks one very simple binary question.
Is the market going up or down?
It is a totally surface-level inquiry.
But campaign logic looks at the exact same screen and asks a much deeper two-part question.
What stage is this move in, and is it still supported by capital?
And that shift in questioning, it changes your entire relationship with risk. You stop obsessing over the random squiggles of the daily price action, and you start looking for the engine.
It reminds me of surfing. I'm not a professional surfer, but I've spent enough time getting battered by waves to understand the mechanics.
Let's hear it.
Using trend logic is like standing right at the shore, in the shallow water, trying to ride the turbulent white water.
Right, because that's where the movement is most obvious.
Exactly. You can see the foam, you can hear the crash, but it's chaotic. It's crowded with other beginners, and the energy is already dissipating into the sand.
You are exhausted trying to catch every little ripple, constantly getting thrown off balance because the structure of the wave is already collapsing.
But campaign logic is the experienced surfer sitting way further out past the break. They aren't looking at the white water.
They are watching the horizon.
Right. They're looking for the dark line of energy forming deep underwater, the swell. They wait for the origin of the wave, they align themselves with that deep energy, and they ride it smoothly all the way in.
If we connect this to the bigger picture, what you are describing is the concept of continuity.
Continuity.
Yeah. In campaign logic, trades are not isolated coin flips. Every single decision you make, every entry, every exit, every adjustment of risk is intimately linked to a much larger thesis.
You aren't just buying because a line crossed another line.
No. You are buying because you believe the central bank liquidity cycle has definitively turned, and you are trying to capture the middle innings of that specific capital flow.
Which means your psychological relationship with the market transforms entirely.
It has to. Under trend logic, pullbacks, consolidations, sudden spikes in volatility. These are terrifying interruptions that make you question everything.
You just stare at your screen, sweating, wondering if the trend is broken.
But under campaign logic, they are simply expected phases of the campaign process. You expect the market to breathe.
You expect periods of digestion.
Right. You don't panic because you know the narrative engine is still running and the institutional capital is still slowly executing its mandate.
Okay, let's put this into practice. Let's run a simulation. We have our two traders. One is armed only with trend logic. They have their compass.
And the other is armed with campaign logic.
Yeah.
They are reading the weather, the fuel gauge, and the map.
Exactly. Let's walk them through the exact same market cycle, looking at the exact same chart, from the birth of a move to its death. Let's start with phase one, strong expansion.
Okay, phase one. In the early days of a new move, both traders are actually going to look like geniuses.
Because everything is going up.
Right. The market has just digested a massive new narrative. Let's use the spring of 2020 as an example.
Okay, the Federal Reserve announces unprecedented, infinite quantitative easing to combat the pandemic lockdowns.
That is a historic narrative. Capital violently shifts to respond to this flood of liquidity.
And the trend structure becomes gorgeous very quickly. The higher highs are clean, the pullbacks are shallow, and hold exactly where they should at the moving averages. Continuation trades just work effortlessly.
The trend logic trader is incredibly happy. Their rules are working perfectly. They are buying the breakouts, the lines are moving north, and they are making money.
So what is the campaign logic trader doing differently here? If the financial result is the same, why does the underlying philosophy matter at all in phase one?
Because the campaign logic trader is participating with a completely different level of awareness.
Yeah.
And that dictates their risk sizing and their conviction.
They are executing the same technical entries, perhaps, but they know why the alignment is so strong.
Yes. They understand that this is the expansion phase. They know this is the easiest, most aggressive money of the entire cycle because the macro narrative is fresh.
And institutional capital has a massive multi-month mandate to get fully allocated.
They aren't just trusting the line on the screen, they are trusting the printing presses at the central bank. Their conviction allows them to press their winners harder.
Now here's where it gets interesting. The market doesn't stay in phase one forever. Eventually we enter phase two. Maturity.
The easy money has been made.
Right. The narrative isn't a secret anymore. It's being discussed on mainstream financial news networks.
And this is where the two logics begin to severely diverge. The trend logic trader looks at the chart and says, the trend is intact. The moving averages are still sloping up.
They assume the party is going to go on forever with the exact same momentum.
So they keep applying the exact same sizing and the exact same aggression to every new breakout.
But the campaign logic trader is looking beneath the hood. They are checking the internal mechanics.
Yes. The campaign logic trader becomes highly selective in phase two. They recognize that while the price is still moving up, the quality of the movement is degrading.
They can see that the trade is getting heavily crowded.
Think back to late 2020 and early 2021 with the massive tech and crypto rallies.
Oh, yeah.
The momentum was still pushing prices higher, But the profile of the buyer was changing. Institutional capital was no longer aggressively accumulating,
They were transitioning to holding.
or maybe even quietly starting to distribute their massive positions to the retail traders who were finally arriving late to the party, driven by pure FOMO.
The campaign trader knows the wave is nearing the shore. The energy is shifting from the deep underwater swell to the choppy white water.
They recognize the maturity of the cycle. They might still take trades to capture the remaining upside, but their risk parameters tighten drastically. They aren't betting the farm on late-stage breakouts anymore.
Which leads us to the tragedy of phase 3, exhaustion. This is where the real pain happens.
It really is.
The market has run out of new buyers. The narrative is fully priced in to absolute perfection.
And the structure begins to fracture. The momentum visibly slows down.
The price might make a marginal new high, tricking the breakout traders one last time, but it immediately dumps. And what does the trend logic trader do?
They see a slowing momentum as a standard, healthy pullback,
They pull up their chart, they draw their tools, maybe a Fibonacci retracement.
which for anyone unfamiliar is just a mathematical tool traders use to guess where a pullback might bounce based on ratios found in nature.
Right, and it works great during strong trends because everyone is looking at the same lines, creating a self-fulfilling prophecy.
So they draw their lines, find a level, and say, a perfect dip to buy.
They aggressively step in, blindly confident that the trend is still their friend.
And they walk right into a trap. They provide the exit liquidity for the smart money.
Exit liquidity.
This is a crucial concept. When institutions need to sell billions of dollars of stock they bought in phase 1, they need someone to buy it from them.
And in phase 3, the trend logic trader, constantly trying to buy the dip based on historical lines, becomes that buyer.
Because they are only looking at the historical direction, they completely miss the fundamental exhaustion occurring in the present moment,
But the campaign logic trader is sitting on their hands.
or actively reducing exposure to zero. They see the same slowing momentum, but because they are tracking the narrative and the capital flows, they know this isn't a healthy pullback.
They know the engine has run out of gas.
Think about late 2021 into 2022. The narrative fundamentally shifted. Inflation ran hot, and central banks broadcasted that they were going to aggressively hike interest rates.
The era of free liquidity was over.
But the trend logic traders kept buying the dip in tech stocks all throughout 2022 because they were looking at the massive historical uptrend.
While the campaign logic traders saw the narrative shift, realized the capital flows were reversing, and systematically de-risked.
They preserved their capital while the trend logic trader gave back all their phase 1 profits.
And then the final nail in the coffin, phase 4, transition. The messy, violent breakdown. The old narrative is dead, but a new one hasn't fully taken over yet.
Direction becomes utterly unclear. The market thrashes wildly, up 3% one day on a piece of ambiguous news, down 4% the next day.
Major support levels break, triggering panic selling, and then massive resistance levels break, triggering short squeezes.
The compass is just spinning rapidly in circles.
And the trend logic trader flails. They try to short the breakdown, thinking a new bear trend has started, and it violently squeezes higher, stopping them out.
Then they try to buy the subsequent bounce, thinking the bull market is back, and it violently dumps.
They force trades because their entire belief system demands they find a direction. The psychological devastation is immense because they suffer massive consecutive false signals.
It breaks people.
And the campaign logic trader, what is their secret strategy for phase 4?
The secret strategy is doing absolutely nothing. The campaign logic trader simply accepts the instability. They understand that during a transition phase, there is no campaign to participate in.
The capital flows are confused and contradictory.
The macro narrative is muddy. Institutions are repositioning, not driving a clear trend. So the campaign trader stops executing.
They shift entirely to observation mode.
They protect their mental capital, preserve their account balance, and calmly wait for the horizon to show the next definitive swell.
So what does this all mean? We've spent this time completely tearing down trend logic. We've exposed how it traps people.
We have.
But the goal here isn't to tell you to delete all your charts, throw away your moving averages, and just stare at Federal Reserve press releases all day long in a dark room.
No, not at all.
We want to synthesize this. How do we marry the best parts of both worlds to build the ultimate framework?
That is the perfect way to frame it. This is absolutely not an argument to abandon technical analysis completely. That would be foolish. Trends are a real phenomenon.
I mean, you can't deny a chart that has gone from $10 to $100. It happened.
It happened. And the trend structure is the visible expression of a campaign unfolding. You need a way to measure that visible expression to optimize your entry and exit points.
It's about hierarchy.
Exactly. Within a properly structured campaign framework, trend logic is demoted. It is no longer the CEO of your trading decisions. It becomes the chief operating officer.
Okay, I like that.
It is a highly effective subtool used strictly for execution rather than the primary basis for decision-making.
Let me make sure I have this right. The direction, the overriding bias, the deep conviction that comes exclusively from the campaign.
Yes.
You derive your overarching strategy from the macro narrative and the institutional capital flow. But the actual timing, the precise moment you click buy, where you place your stop loss, how you manage the risk of the open position that comes from trend logic.
Trend is the tactic. Campaign is the strategy.
Trend is the tactic. Campaign is the strategy. So let's bring this down to earth for the listener. You sit down at your desk tomorrow morning to look at the markets. What is the mental journey you take to apply this synthesized framework? Where do you even begin?
You begin by finding the narrative. This is the absolute foundation. Before you even open a single price chart, you have to identify the macroeconomic or fundamental driver that is currently moving the market.
Like what we talked about earlier.
Right. Are we in an environment of expanding global liquidity? Is there a structural deficit in a key commodity? Are central banks coordinating a major policy shift?
And if you look around, read the macro landscape, and you simply can't find a massive unifying narrative.
Then you stand aside. If there is no overarching driver, there is no campaign to build. You are just flipping coins in the noise of a transition phase. You must identify the engine first.
Okay, let's say you found the engine. You have a clear narrative. The next step is locating the face.
You have to honestly, objectively assess where we are in the life cycle of this narrative.
You have to ask yourself the incredibly hard questions. Is participation just starting to quietly expand? Is the smart money just beginning to build positions?
Or is this narrative already on the cover of mainstream magazines?
Right. It's gasping for air. Is everyone you know already talking about the trade at a dinner party?
This requires extreme discipline and brutal honesty. The FOMO is going to scream at you that it's phase 1, even when it's clearly phase 3.
You desperately want to believe you are early.
But you have to look at volume. You have to look at the market's reaction to news. If a market gets incredibly bullish, fundamental news and fails to rally, that is a massive tell.
It tells you are likely in the exhaustion phase.
Exactly. The buyers are already fully allocated, and there is no marginal capital left to push the price higher, regardless of how good the news is.
Once we have the narrative and we know our phase, that is when we finally look at the chart. We validate with structure. We bring trend logic back into the fold.
But we use the trend tools, the moving averages, the trend lines, the price action, not as gospel, but as a polygraph test.
A polygraph test. I love that. You are interrogating the chart.
You are asking, does the physical price action validate the macro story I believe is happening?
If your campaign thesis is wildly bullish, but the trend structure is constantly making lower highs and breaking major support levels, the polygraph is showing deception.
The chart is explicitly telling you your macro thesis is either wrong or you are simply too early and the capital hasn't arrived yet.
But when they align, when the polygraph passes,
when the narrative is a powerful tailwind, you are confidently in the expansion phase. And the trend structure is making beautiful higher highs and higher lows.
that is when you step on the gas.
That is when you have high conviction context. But when the narrative and the trend structure begin to diverge, you exercise extreme caution. You reduce risk immediately.
The final piece of this is adaptation. You have to deeply understand that your objective in the market is not to catch every single microscopic squiggle of price action.
Your objective is not to be right on every 5-minute candle to prove how smart you are.
Trying to catch every move is entirely ego-driven.
It is. Your true objective is to stay aligned with the dominant capital-backed move for exactly as long as it remains valid, and not 1 second longer.
As the campaign evolves from expansion to maturity to exhaustion, your exposure, your risk limits, and your expectations must adapt with it.
Exactly.
We have covered a massive amount of ground today. We started in this comfortable, warm little bubble of just observing obvious direction.
The trend is your friend. Higher highs, higher lows.
It feels so safe.
But as we've seen, that comfort is an illusion that ultimately leaves you deeply vulnerable to the reality of how markets actually function under the surface.
We've moved from that surface level observation to a deeply analytical 3D process of understanding market development.
Trend logic keeps you trapped, constantly reacting to what is already visible, what is already priced in.
It keeps you staring at the compass while driving off a cliff. Campaign logic is what actually lets you engage with what is actively unfolding.
It lets you read the weather, understand the fuel gauge, and anticipate the journey.
I want to reinforce the core value of this paradigm shift for anyone listening who might feel a bit overwhelmed by the idea of tracking global capital flows and macroeconomic shifts.
It can be daunting.
Adopting campaign logic does not eliminate uncertainty. Nothing in the financial markets will ever eliminate uncertainty.
If someone sells you a system that promises no uncertainty, run the other way as fast as you can.
What campaign logic does is it finally places that inherent uncertainty inside a coherent, manageable, and logical framework.
It gives you a reason for the volatility. It stops you from being a passive victim of sudden reversals.
Yeah.
Because you begin to anticipate the internal degradation of the trend before the price snaps.
It is the shift from following the price like a shadow to understanding the entity that is casting the shadow.
Beautifully said.
I want to give you, the listener, a specific mental exercise to try right after this deep dive ends. Pull up a chart of the S&P 500 from the last 5 years, but don't just look at the price.
Right. Overlay a chart of the Federal Reserve's balance sheet, the actual measurement of liquidity in the system.
Watch how the massive expansions and contractions of that liquidity map onto the major structural turns in the market.
That is the beginning of practicing campaign logic. It is tracking the fuel, not just the compass.
It is a powerful exercise that instantly changes your perspective.
It really is.
Before we sign off, I want to leave you with a provocative thought, something to really chew on. We've spent this entire deep dive establishing that a true campaign is driven by large-scale narratives and the slow, heavy movement of human and institutional capital over time.
The unfolding process is entirely dependent on that concept of time.
Right. But what happens to your carefully measured campaign phases and your institutional capital flows when artificial intelligence begins reacting to and pricing in massive macro narratives faster than human capital ever could?
Oh, wow.
If the speed of the campaign process from the birth of a narrative to its total exhaustion accelerates from months to weeks, to fractions of a second driven by algorithmic interpretation of global news,
That changes everything.
will the human capacity to even process campaign logic survive? Or will human-drawn trend logic become an entirely obsolete relic of the past?
That is a terrifying and brilliant question.
Yeah.
It forces us to ask if the time element of our campaign triad is about to compress to absolute zero.
Something to mull over the next time you stare at a chart. For now, we want to challenge you. Take a hard look at your current market biases. Look at your open positions. Ask yourself, honestly, are you just following the compass, hoping the line keeps going north? Or have you actually bothered to check the fuel gauge? Thank you for joining us on this deep dive.